Hello, hello. Hey, everybody. Thanks for joining us. It's Adam here, co-founder at Defactor. We've also got Sharif, co-founder, head of technology at Defactor. So it's been a pretty quiet week for Defactor, right? Not much has
Another
happened.
qui- another quiet week, yeah.
Yeah. So, of course, what we wanted to do today is talk about the most recent governance vote that we've had, which is kind of one of the most significant upgrades that we've made in the Defactor ecosystem. And this is the migration from FACTR to our new token, Real. So we wanted to kind of gather all of the user feedback, kind of community feedback, and just see what people really wanted us to address. So we thought it'd be better to do it on a video format. So,
All
anything you'd
right,
like
let's
to
go.
add, Sharif, before we kick off?
No, let's jump in. We did have a quick read through the questions, and there's obviously some excitement and some anxiousness around as to why we're doing these things. So happy to put some color on it and give some info.
All right, well, let's do it. Well, look, as I said, I'm going to just read down through the questions and we'll provide some answers and some color as we can. So I guess first and foremost, so Real token. So what are the main differences in Real's tokenomics compared to Factor?
Yeah, so I guess the main focus, if people remember, we had a token swap for Factor about 2 years ago, and one of the kind of drivers for that was stretching the token from Ethereum to Polygon, and that opened up some opportunities, but also gave us some challenges in terms of kind of fragmented liquidity and arbitrage that was happening with the various different traders within the ecosystem. What we've done with this move to Real is two main things. One, really focus in on the niche that we're building for, which is the real world asset space, and also move from a tokenomics model, which was you know stationary in terms of supply, as in a max supply of 300 million, into a deflationary, more scarcity driven tokenomics model. How we're doing that is essentially by burning unused tokens. There's always a bit of concern when there's large token holders and foundations and DAOs, etc., that as soon as there's new entrants coming in or new token holders, that there's a risk that people get dumped on, and it affects the project and things. We've never done that within Defactor. We've never sold a single token from the project's perspective or for us as founders. So what we've proposed, and it's been supported through the governance vote, is that as we're generating revenue in the protocol, we'll continue to buy back tokens as we have been doing with Factor, but half of those tokens now, which are bought back on the market, will be burned on a regular basis. And also then to really solidify this deflationary scarcity-driven tokenomics, we've taken the move that immediately post-migration, 20 million real tokens will be burned as an initial kind of show of, this is the way we're operating this project going forward. So, in summary, much harder tokenomics, more scarce token where the tokens are fully distributed. They're all owned by participants and investors in the ecosystem. And if people want to get some, they need to buy them on the open market rather than ever being fearful that more is going to be, created or sold on top of them.
Yeah, excellent. And I think what I like to think about it just is that we're simplifying it. We're hardening the tokenomics and simplifying. So one-to-one swap for all holders, fixed supply, fully distributed, no future emissions. And I think if the community can think back, we did a pretty significant governance vote last year to lock 100 million tokens. And those tokens have been kind of, I guess, hanging over everybody. You could see it in a wallet and what's going to happen to those. So I think the burn really signals what we're doing as we're moving towards this kind of harder tokenomics model, and the buybacks continuing and the buybacks also facilitating more burn. So I think it proves that we really want to go to a model that's funded by real protocol revenue and not by inflation. All right, excellent. So I guess simple question, maybe not a simple answer, but why the change to real? And didn't Factor already build brand recognition? So why real?
So I'd say Defactor has built a really good brand and has really good positioning. Um, how the Factor token name came about originally was, when we were penning the white paper, we thought that invoice factoring would be a big thing, or decentralized invoice factoring, and that's how we came up with the idea of Factor. As we've evolved and developed a fully functional toolkit for the real world asset space, it didn't quite sit right. And we saw an opportunity to basically grab the ticker within the base ecosystem and kind of put a flag on the ground to say, this is a real project. We're building real things. We've got real users. We've got real capital coming through. Um, and as you know, we've also been running dozens of events around the world with the hashtag RWAs get real. And maybe that kind of lent into some of our thinking as to, if we're reworking this and we're going to rebrand it, let's have something that will last for years and decades. So really excited about it. Everybody that we've shown it to has also been quite excited about it.
Yeah, and I can't tell you how many times people have misspelled Factor, FACTR, where they're saying, "Hey, I can't find your token, FACTOR, ER, what am I typing in?" So I think real, obviously it's easy even for multilinguals, etc. Yeah, 4-letter ticker I think works a lot. Alrighty, so let's move over to the next one. So why was the total supply reduced now instead of later, instead of after kind of more adoption or more holders? Why do it now?
Yeah, I guess the initial burn of 20 million is a real signal that this is our intent, and we're putting our money or our real tokens where our mouth is. Subsequent burns will be milestone based or announcement based, and we've got a huge pipeline of stuff that we're working on. But it's not something that we want to signal as to it's going to happen now. But we have a target supply in mind. We have no intention of selling any of the locked tokens that we've got. We kind of see them as being supporting the ecosystem and supporting the growth of that, and deflation and these burns is a key part of that strategy. So why now? Yes, we want to start off on the right foot. More will come, both on a kind of gradual basis as we're buying back, but also we will have these milestone burns based on key activities and key achievements. So they're kind of things for our token holders to be excited about, not just okay, what are the guys building, whether it's useful or not, but after something is achieved, now their investment in real, or their real holdings, essentially goes up in value because of a significant milestone burn. So that's really part of our thinking on the strategy for all of this.
Yeah, I second that. Plus, also, as I mentioned, those 100 million tokens, it was timely. So resetting it now and introducing some of those burns, it avoids some long-term uncertainty about unlocks, emissions, everything like that. So early clarity is what we want to build trust, and especially for new token holders, new partners, new projects, etc. So yeah, that's great. Okay, so next up, so is focusing only on base risky? What if the chain loses momentum or liquidity or something happens? So yeah.
Yeah, I mean, you've got to hit your horse somewhere, right? We've been super impressed with the base team and the Coinbase team and how they've been growing that network. Super bullish by the direction of having an everything exchange. We see this as being a pivotal moment for not just projects like Defactor to find a home within an ecosystem that's growing, but also the asset originators that are looking to use our technology in order to deploy it. We see Base as a natural home for these tokenized assets. Is it a risk? There's a risk with all of this stuff, but as we design and make these changes, we've always got optionalities, so that if there's a bigger and better chain that makes more sense in 3 years' time, we'll have a migration path in order to continue to upgrade. And what we're building is software, and software continues to get patched and continue to get upgraded. So Base Absolutely, we think it's the right choice for now. We're excited to get closer to the base community and the builders on base. We hope to be funding a grants program in the RWA space on base using Defactor technology. And super excited about it. Should any of our customers want to deploy in any other EVM chain, we're completely open to that, and our toolkit works basically everywhere Solidity does. So that's how we've approached it.
Yeah, and when I saw this question, I thought it was important to emphasize that too, that this is not for the toolkit or the Defactor tooling per se. Like, that's available on EVM compatible chains, even private networks if they're EVM compatible. So yeah, this is primarily talking about the real token, consolidating that liquidity. Yeah, and basically trying to go with the great momentum that Base and Coinbase have made in the past couple of years. Okay, so next up, so how do you prevent large holders, whales, from dumping after migration? These are some meaty questions.
We've got an open market. As part of the migration strategy, we accelerated all of the staking rewards. So every holder now has all of their FACTR. As we're talking on the, I don't know what date it is, it's a blur, but as we're talking kind of mid this migration period, the 26th of August, every token holder has their FACTR tokens liquid, and there's a functioning market there. Should they lose faith in the project, or they decide that the price is the right time to exit, they can, and they will. And we've got, thankfully today we're seeing more buyers than sellers on this project. But that's the approach that we've taken. Accelerate all of our staking rewards. Take the pain now in terms of having liquid tokens that are freely available and trading, and then make a case for people to buy and hold them into the migration and for the next phases of the project. And the other kind of lens to this question is, if there's large dumpers of tokens or large sellers, it gives other people an opportunity to buy at a lower price. And us ourselves in the project have been buying back our tokens all the way through, and we'll continue to do so. So I don't necessarily see low prices in the short to medium term as being a problem. I see them as being an opportunity for people.
Yeah, I'll do as I usually do, and I don't really like to comment on tokens other than saying they're your tokens. So if you like the direction of the project and you like what's happening, etc., of course, that shows your support. So if you don't, we've got a liquid market. The tokens are available on DEXs and SEXs, but I will say that we're showing up every single day. I had a lot more hair when I started this project because we're really rolling up our sleeves and we're going for it. So yeah, who knows? Okay, so now I guess it's more into the kind of nuts and bolts of it, kind of what exactly happens with the migration. So what exactly with the factor to real migration, what are the steps? First of all, why was it done? So let's start with that one, and then we can get into the steps.
Yeah, so essentially, in order to execute or to move from factor to real, factor will be frozen in everybody's wallet, and they will get an airdrop of real in the same wallet but on base. And why was it done? But basically to, as we mentioned, to really harden the tokenomics, to really recommit to real world assets as being the niche that we're building our tooling and our infrastructure for, and to consolidate liquidity activity on one network, so that as things start to build and more revenue starts to come in, that it's driven into the real token, as opposed to being fragmented and opportunities for arbs and bots and stuff to make to make earnings within our project. So that's the kind of why, and that's the how this will happen. Token holders don't need to do anything. If they hold factor into the migration period, real will appear in their wallet, and then they're free to do with those real tokens what as they choose.
So now again, it's on to how would the migration work, and do holders need to take any action? So as we've been saying, if you hold factor tokens in your wallet and you've held them through the migration process, you don't need to do anything. You're going to see real tokens in your wallet. You may need to just add the base network to your wallet if you're using MetaMask or something similar. And then as it relates to the centralized exchanges, they're supporting the swap process, but they've got their own distribution schedule. So just stay tuned and we'll announce any issues or flags that come up, but we don't foresee any. If you're a holder on Gate or Mexi or any of the other centralized exchanges, we don't foresee there being any issues there.
Yeah, and just kind of one final word of caution: you may need to add the base network, and you may need to add a custom contract, which is the real token. Make sure that you get those from our website as opposed to anywhere else. You know, the space is flooded with scams and people trying to scam people, and never send your real tokens to anywhere unless you really know where they are. So
awesome, good crypto housekeeping there. Okay, so that's on the migration, and now we want to talk around the swap ratio. So again, we're talking here a 1-to-1 swap. So if you've got 3,000 factor, you now have 3,000 real, and that's essentially, so it's a 1-to-1 swap ratio. The second part of this question, is real permanently replacing factor? Yes, factor is being retired as the fuel of the Defactor ecosystem, and it is now real, which is now the fuel of the ecosystem. So this is a permanent change. Of course, will be all of our documentation everywhere that you see factor, you will now see real. You may see real formerly Defactor for a little while, just to make sure that people who aren't checking are up to date. But yes, it's a permanent replacement, and the swap ratio is 1-to-1.
yeah, 1-to-1. We're essentially, taking off a sub, which is factor, and putting on some fresh legs, which is real, into the new phases of the project.
Okay, so then next is on the blockchain. So again, we've mentioned this a couple of times, but just to say it kind of clearly, which blockchain is real on? It's on the Base blockchain. And why was Base chosen over others? I think we've touched on it, but we really like what Coinbase is doing, the growth that they've seen, their alignment towards real world assets, and even Coinbase as a company, the way that they have conducted themselves over the crazy crypto cycles. Yeah, we like what they're doing. So okay, so next up, what happens to the liquidity on Polygon and Ethereum after the move?
Yeah, so essentially we're consolidating all of the liquidity, or all of the project provided liquidity onto the Base network. So we'll be pulling down the LP, the pools that we've got on Uniswap. All of that funding will be bridged and then provided on the Base network on Uniswap and also Aerodrome. So essentially, it's consolidation of liquidity at deeper pools. And one of the things that we've been told numerous times is that there's larger buyers that are interested in deploying, 5K, 10K, maybe more into our project. And because our liquidity has been so light, that slippage on the upside has been a real, they've been put off by it. So we're hoping to have much deeper levels of liquidity post this migration.
Okay, excellent. And again, that's one of the number one requests. So you heard it here first: deeper liquidity, consolidated markets on Base. Okay, next up, we're going to talk around some of the token mechanics and how that works. And first of all, I think a lot of the community is excited that we're introducing burns, and pretty significant burns, the first of which 20 million tokens. But let's just talk a bit about that. So how does that inaugural 20 million token burn work, and will there be more?
Yeah, so essentially, post distribution, everybody gets their real tokens. We will be burning 20 million from the 100 million that's being locked until 2026 as a first intent of, Defactor is now a deflationary project. Up until now, we were operating on a fixed token supply. From now on, we'll be operating on a deflationary token supply. So there will never be any more than the initial amount that are minted, which is 300 million. There will only ever be less. Will there be more? Yes. Do we have an idea of when they'll be? Kind of. But we're aligning them to key objectives and milestones that we're building from. We don't want to just, as we saw in other networks, tokens are burned and nobody even notices occurs. We want it to be really part of the strategic momentum of what we're building. And we also want it to be a surprise for the market as well, to give people some interest. They can continue to check back. They can see what the token supply is today, and in the future it will be less than that. So the value of their holdings proportionally should increase as we're doing this. And that's the tokenomics model that we're moving to, and people have supported it very positively through our governance votes, etc. So
Yeah, and again, it's been one of the kind of key requests that we've gotten from token holders is to introduce that deflationary model and also tie it to the buybacks as well. So yeah, that's how this inaugural 20 million token will burn. And please stay tuned to engage.defactor.com, all of our social channels and websites to find out when there will be more burns. All right, so then let's move on to talk around the buyback model. And of course, we've been running the buyback and make model for quite a while. We've done over $400,000 in buybacks. And we have gotten a lot of questions about now this revenue driven buyback function, and also this kind of buyback and burn. So let's talk a little bit about that buyback model and how it relates to the real token.
Yeah, so we've been running buybacks now for about 2 years, and as you said, we've bought back somewhere between 4 and 5% of the supply, almost 12 million tokens. The project has spent over $450,000 of USDC in order to do that, and that provides liquidity into the market. Up until now, the plan was for those tokens to be dripped back into the ecosystem buckets, and as we've had on our video, kind of this circular economy. We believe now is the time to accelerate that, and half of the tokens going forward, which are bought back, will immediately be burned. So essentially, continuously buying from the market based on activity that we've got in the ecosystem. So more clients, more revenue, more usage, more buybacks, and more burns. So we're really shifting between this buyback and make and keeping this fixed supply to as we're continuing to grow and bringing on new clients and new revenue, it's going to drive the deflation within the ecosystem. And this is a model that we believe will be understood as to really clean economics and really clean tokenomics, and something that people can see on chain and track the momentum of the project through it.
Yeah, well said. Okay, so that's how the revenue-driven buyback will function, and I think everybody's really excited to see some of those buyback and burns in action. And again, on engage.defactor.com, that's where you'll see our buyback dashboard. That's all going to be updated with the real token, and you'll be able to follow along with those burns as they happen as well. Okay, excellent. So moving on, let's talk about where the community can buy real. So again, it's been a question that we get. Once the migration happens, where can I buy real, and what trading pairs will be available?
Yeah, so I guess just a kind of reality check of where we are within our current market at the moment. Over 80%, 85% of our tokens live on chain and are traded in our dexes, and we're staked in our staking platforms, etc. So I would always recommend that people buy for the best price on the decentralized exchanges. We'll have a trading pair on Uniswap, and we'll also have one on Aerodrome. We'll make it super simple for people to be able to buy and trade directly from Defactor's own website, and from our token portal, and then check on the likes of CoinGecko and CoinMarketCap, the other markets that are supporting it. But we're really seeing a drive in interest in the dexes, and we think it will be soon when through your Coinbase interface you'll be able to buy real, and you'll also be able to buy assets that are minted from our ecosystem. This move by Coinbase to have an everything exchange and list DEX pairs, I think, is going to be a game changer. So that's I'm not sure when this video is going out, but check on the likes of CoinGecko or check on our own websites as to where you can buy the real token. ensure that you're buying the right one, double check the contract address. And if you've got any questions or any concerns, reach out to the team. We're not hard to find.
All right, absolutely. So then from where people can buy real, let's move on to talk about the centralized exchange strategy. And will real be listed on more sexes, or is the strategy to kind of go DEX only or kind of lean more into the DEXs?
Yeah, I mean, the majority of tokens that I have bought over the last year has all been on DEXs. The volumes that DEXs are doing is, you know, incredible and only growing. So as of today, and these things can change because, you know, independent companies can make their own decisions. But as of today, both Gate and Mexi, which are our two primary centralized exchanges, are supporting this token swap, and supporting, you know, the next leg of Defactor's journey. And we envisage that more centralized exchanges will list real as we gain momentum and as we continue to grow on this journey. But personally, I would very much be a DEX first investor, or DEX first crypto builder in this space, and, you know, believe in decentralization and these opportunities. You know, the closed gardens that centralized exchanges can offer, they can be great for some projects, but we've seen some real problems with other projects where tokens were locked and lost, and customer service hasn't been up to scratch. So, yeah.
All right. So to summarize, it's not a DEX only strategy, but it's a DEX first strategy. Of course, FACTR and now Real is available on our centralized exchanges, but we want it to be kind of momentum driven. If other sexes want to list the Real token, by all means, of course. And we want that to be driven by volume and appetite to list that token. So for now, you can find it on our current sexes. Check out CoinMarketCap, CoinGecko, check on Defactor website, defactor.com, and you'll see all of the markets where Real will be listed and where it's available.
And if you've got a favorite exchange and you want them to list Real, tell them to list Real.
Yeah, I like that. I like that. Okay, so if we're talking about liquidity and we're talking about consolidating the liquidity on base, how does that benefit token holders? How does moving from kind of a multi-network, kind of multi-liquidity pool, consolidating that to base, how does that benefit the token holders?
So who it doesn't benefit is the bots and the trading bots. So let me give you an example of what was happening. We were doing quite aggressive buybacks for a period on the Ethereum side of our Uniswap pool. So we might buy back $20,000 within a day, and immediately we would see buying happening on the Gate exchange, or buying happening on the Polygon side, and bridging over in order to essentially capitalize on those arbitrage opportunities. And the average token holder isn't sophisticated enough to do that. So those arb opportunities for these bots, they do provide a service in that they provide some trading and liquidity for the markets, but it's also leakage from the overall value of the ecosystem and for the token holders. Now that everything is consolidated on base, those arb multi-chain arb opportunities won't exist. There will still be some between the centralized exchanges and the DEXs, and we expect some bots to be participating in that bit. But essentially, it's a fairer price where everybody's looking at the same order book. Everybody can buy and sell at the same price without having to think about, okay, it's 8% more expensive on Ethereum. I'll wait until these things adjust. So it's a single view, single lens, and deeper liquidity. So, just because we've got, even if we just combine the pools we've got in Ethereum and Polygon into one market, the impact to move, by 2% or 5% through a buy or sell order will be diminished, and we'll be able to accept larger buys and sells as we go along.
Okay, excellent. So that's consolidated liquidity and how it benefits the token holders on base. So thanks for that, Sharif. And then next up, what we've got is 1 second. So we're into the platform and the ecosystem and how the real token integrates with Defactor's tokenization platform, Defactor's toolkit. So let's talk a little bit about that. So how does real integrate into Defactor's tokenization platform?
Yeah, it's actually super simple and follows the same model as we've used for FACTR. Real is a utility token. It's essentially a fee collector. And we've got a deployed buyback contract on the various EVM networks that we are. You're able to send stable coins to that based on platform revenue or other revenue generating activities, and it automatically executes those buy orders. We're now able to essentially collect revenue on any different network, direct that revenue to the buyback contract within base, and execute that buyback. So it's very much back end technology that's continuing to collect fees within the ecosystem. And not just within the Defactor tech, but as we start to move and deploy Defactor's technology into other networks, we're able to collect fees and stable coins, direct them to base, and then direct them to the buyback contract for FACTR. So that's kind of how it works in the background. Pure utility token, fee collector, which has been running for about 2 years now.
Okay, so that's how the real token integrates with Defactor's tokenization platform. And then I guess moving on then into the utility side of it, it's all about, do you have to hold real in order to use the Defactor technology, or does using the platform require holding or spending real? And I guess I'll take that one. It's on two sides, right? So yes, we have a program available where new customers, if they hold the FACTR token, are able to stake that and get access to the toolkit. That's going to continue through into the real ecosystem, but it's not required. We've got Web 2 customers. We've got people that don't hold tokens. Some of our customers, their first wallet was when we were creating tokenization and tokens for them. So we don't want to have it as a gate or to kind of say you must hold real in order to do this. However, by holding real, you'll be able to get access to the Defactor tooling. And other things we can also explore, which we've been speaking to with our partners, is fee sharing, or basically reducing fees if you hold X amount of real. So as Sharif said, it's a pure utility token and we want it to be ingrained in the ecosystem, but we don't want that to stifle adoption or usage. Or if somebody says, oh, I have real, but I don't have real, but I want to use staking or lending and borrowing or tokenization, we don't really want that to be a blocker.
Yeah, I think you've said it really well. And I really consider it as being a background utility. We all obviously have options and optionality to use it for promotion and for marketing activity and to attract people, as it is the currency of our ecosystem. But users want to know what are they getting, and what are they paying for it, and what we've built is a way that revenue can be driven straight back into the tokens, and it's extremely powerful. 2 years ago, 3 years ago, there was people considering that, okay, you have to have these tokens in order to do something. You have to connect your wallet to but the user experience is terrible, and things have moved away from that, and people want to abstract away complexity, get to market very quickly, and that's the way we've built our tooling and our product set.
Yeah, and I think it's increasingly important as we get adoption from the Web 2 or the TradFi, the traditional world, coming into the real world asset space. You don't want to have too many blockers. You don't want to have too many barriers. And we've even seen it before when we try to onboard some of our friends and family. You send them some tokens straight away. They're saying, oh, it says I need Polygon to make the transaction. What does that mean? It's just, you introduce so much more, and we want to try to simplify it. So something we're also working on from the tech side, being able to deploy the toolkit really easy, make it seamless, and even in the future, make it self-serve. And yes, holding the token could maybe get you a discount or access to special services, but it's not going to be a blocker.
Not only self-served, but AI served. It's the new world.
There's some alpha for you, everybody. Okay. So next up, it's actually the final question on our list, and then we can go to a couple of others. So, how can I verify I received my reel after the migration? So migration's happened. How do I verify that I've got the reel and I've got the real reel?
Yeah, so absolutely check from defactor.com that you're looking at the right contract address in your MetaMask wallet or your EVM wallet. And you should, in that wallet on either Ethereum or Polygon, you should see an identical amount of real tokens as you did for Factor. You won't be able to move the Factor tokens, but the real tokens will be fully liquid and tradable and transferable. And then should you have any issues, reach out via email, support@defactor.com, and somebody will pick it up and make sure that you've got what you need.
Yeah, absolutely. And as always, good crypto housekeeping, never share your keys, not your keys, not your crypto. If somebody reaches out to you claiming to be from the Defactor team saying, oh, send us some tokens, we'll send you real, we will never do that. So good housekeeping just on the crypto side, and also just for using your wallet, you may need to have to import the real token contract address in order to see those tokens on your wallet. So just make sure, depending on if you're using Coinbase wallet, should be easy, should be straightforward. On MetaMask, you may need to import the new token by just pasting the wallet address that you'll find on our website. You'll find it on CoinGecko, CoinMarketCap, etc. Okay, excellent. So I think this was good, and these were really good questions. I think we've had, well, a mix of people reaching out to us on social. We've had people pinging us directly, and I think it's good to just kind of get out there and make sure that we've answered everything. If there's, again, something that's unclear, something that you think we need to explain in detail, you can catch us on the website. You can reach out. We've also got us on Telegram as well. Let me see here now. Is there any other questions we should maybe rattle off? I'm just scrolling even through my Telegram here to see, but I can't. Anything else, Sharif, you can think of while we're together?
No, that's it. That's great. Excited to move to this new chapter. It's been a long time coming, and it seems to be well received. So we've got some work to do as always, but excited.
All right. Thanks everybody for the time. Thanks, Sharif. And yeah, Factor becomes real.
All right, let's get real.
Defactor, from start to scale.